So we've scrambled a bit today to get our Zoom settings in the right place, but it looks like we're ready to go. So we'll go ahead and get started. Thank you for joining MU Extension and our featured industry leaders as we share information and resources that are important to you right now. If it is important to you, it's important to us. The webinar series strives to respond quickly to the developing needs of employers, businesses, and communities. Thank you to the Workforce Rally speakers for joining us today. Today, joining us, we have Rob O'Brien, President of O'Brien and Associates, Rob Harrington, the Economic Development Director for the City of Houston, David Gaines, Managing Director at Goldstone Consulting, Andrew Jordan, President of Jordan CPA Services, and at some point we may have our Missouri Small Business Development Center, SBDC, jump on with us. And co-hosting and moderating with me today is Matt Peasold. He and I are MU Extension Labor and Workforce Field Specialist. So make sure that you stay tuned to our workshop registrations. We have new registrations coming in, or new sessions coming up, and we're keeping that updated online. And we're going to start with Rob O'Brien. He's going to be sharing with you information and updates about the SBA programs and the new guidelines for Paycheck Protection Program for independent contractors and self-employed individuals. The presentation is being recorded today, and following the presentation, we'll share the recording and the slides to all of those who registered. Thank you, Rob.
And Amy, thank you, and welcome everyone this afternoon. We're appreciative of you taking your time to learn more about some of the resources available to small businesses during this COVID challenge that we have here in the state. I think we have a good lineup, and especially when we get close to the end, we'll begin taking questions on chat and hopefully be able to fill in some of the blanks for you. We have a number of things to talk to you about today, and we're starting off on those with the small business programs, and those programs are basically four in number that they have available for those: the Economic Injury Disaster Loan, or EIDL, the Paycheck Protection Program, and then last week we talked about SBA debt relief and the tax credits or deferments. But really, I think people are interested in these top two, and so we're really going to focus on those today. The SBA has moved rapidly, no doubt about that, and consequently, if you're watching the news and talking to your CPA or to your lenders, there's lots of confusion, there's lots of overload on the system. Some of the confusion for the economic disaster loan is around what's called the advance loan, which is actually a grant. And then also the continued updates that are occurring specifically on the Paycheck Protection Program, or what's called the forgivable loan, that a lot of people are most interested in because of that forgiveness clause. Talking to an SBA contact of mine this morning, what they're showing is about 1,800 economic injury disaster loans have been processed through for $357 million, and about 178,000 of the Paycheck Protection loans for $50 billion of that $350 billion. So those on average, it's about 200,000 for the economic injury so far, and about 281,000 for Paycheck Protection. Giving you a little bit of background, the Economic Injury Disaster Loan is an SBA standing program. It is used in many disasters. and they basically added additional funds in and will continue to for the EIDL loan. It includes that $10,000 advance grant, and we're going to call it that because it is essentially yours to keep, even if your economic injury loan is not approved. It is not part of, if you do get the loan, it is not part of the loan repayment. It basically is a grant, and it has the same uses as the economic injury for payroll, for bills, for debt service, but no prepayment on debt service, just on debt service, that you can continue to use it. Hopefully we can make this advance again here. Paycheck Protection Program, which is part of the CARES Act. That is also a standing program. It's the original SBA 7A lending program, but it has been modified some and beefed up under the CARES Act. So it now has a $10 million cap on the loan. Typically they do 5. It has an interest rate cap of 1% and a 2-year term. And this was a change that literally came out just as the program opened. Originally, it had an interest rate cap at up to 4% and up to 10 years on any part of the loan that was not forgiven. But they increased the interest rate from, or decreased it to a 1% cap maximum and a 2-year term instead of 10. And it does encourage continued employment or re-employment, bringing people back by forgiving the loan on a qualified basis. That program actually opened last Friday on the 3rd of April, but for independent contractors and the self-employed, it actually opens up again this Friday for them, and it is run through the lending community. So this is not a direct to SBA program. This one is where you go to your bank or your financial institution. So let's do a little side-by-side on these. It has the economic injury disaster loan, as we mentioned, is up to $2 million. That is a negotiated need in which you can put forward what you anticipate needing for the next 6 months. It does have that advance grant that you apply for at the same time for economic injury. And the payroll protection loan is up to $10 million, and it is payroll based, and we'll come back to that in a minute, but that is a very specific guideline for the payroll protection program. Interest rate is 3.75% for businesses. It also is open to not-for-profits with a lower rate at 2.75%. And then the payroll protection loan has a 1% number on it. Terms of the loan for economic injury can go out as far as 30 years. So it does have some legs to it. For both the economic injury disaster loan and payroll protection, there is a deferral of the first payment, although interest is accrued during the period of time. For the economic injury, it's an automatic 12 months. And for payroll protection, it's a minimum of 6 months, and a higher number of months can be negotiated with your banker. So who's eligible? Basically, they're about the same group. Small businesses, and small businesses by the SBA is defined as those under 500 employees. Independent contractors and self-employed can look at that. The payroll protection loan does further define independent contractors and self-employed under the Family First Coronavirus Act, which was passed prior to the CARES Act. And that's one where you can work with your banker on that. And not-for-profit organizations, especially 501Cs, but also D&E qualifiers for the economic injury loan. small co-ops, and tribal businesses. And in addition, for the payroll protection program is a 501c9 veterans organization. So that's an additional one that's noted specifically payroll protection loan program. Application, you go directly to the SBA for your application online. And payroll protection, as we mentioned, they started off as those SBA qualified lenders under 7A, and have continued to add qualified lenders as the program has rolled out. So that's an opportunity for you, especially small businesses, to take a look at who else is out there that may be able to bring the loan to you. For economic injury, it's currently open. As we mentioned, payroll protection opened last Friday, except for independent contractors and self-employed. Your application timeline opens this Friday. The economic injury disaster loan has a long timeline to apply. It's almost to the end of this year. And the payroll protection loan has a very short timeline, essentially to June 20th of this year. So it is one to take a look and make sure that you can be timely with that one in particular. We're getting some lag here in the system. So the loan calculation, and this is the 2.5 times your monthly average payroll cost, is pretty well known for Paycheck Protection. Less clear is what you can do with economic injury, but it really is, it's needs-based, determined by the level of economic injury within or projected for about a 6-month window. And the request is reviewed by the SBA. At the same time, you request the emergency grant of up to $10,000, or as they say, the emergency advance, which becomes a grant. On Paycheck Protection, there are certain things that are included when payroll is calculated. And basically, it's salaries, as you might expect in payroll, but also employee benefits, including health insurance premiums and retirement benefits. It includes state and local taxes paid on those salaries. And for sole proprietors, it is also considered compensation that comes within a sole proprietor business to the sole proprietor. It does exclude, however, wages over $100,000. So you can only take that line up to that point. It excludes people who do not have a permanent residence in the United States. The residence is outside of the United States. It excludes those contract employees, 1099 workers, and others because they can ask on their own for the Paycheck Protection Program. And it also excludes the FICA and income tax withholdings noted at the federal level. Economic injury disaster loan. There is no loan forgiveness, period. No loan forgiveness. It is a loan, but you can use that for a variety of uses as noted here. For Paycheck Protection loan, the forgivable loan is based on the payroll cost incurred during the covered period. Basically, once you receive the loan, it's an 8-week window of time. So it's an 8-week window on receipt of the loan to track all of these payroll costs, and then you compare them to a similar time last year or prior to the COVID virus impact. Now, note on here that the SBA guidance really stresses 75% of this really goes to the payroll. These other things, mortgage interest, rent payments, utility payments, are allowable, but if you do not pay at least 75% into the payroll categories, you run the risk of having your forgiveness reduced on that. You can also rehire in this program by June 30th to restore your full-time employment and salary levels for changes made between February 15th and April 26th. So if you've had some adjustments in this time frame that we're in now, you can rehire up until June 30th and be qualified. Basically, there is no collateral required for either of them. There is a personal guarantee on the economic injury disaster loan, but not if it's for less than $200,000. There is no personal guarantee on Paycheck Protection. There are no prepayment penalties if you decide you don't need them. The thing to note is that's been confusing somewhat with the Paycheck Protection loan can address was the good faith certification, and that was pushed a lot in the early stages of that basically you're making a good faith certification that you have all intent to use the money correctly. You understand the use of the loan, you have need of the loan, and that at the point in time when you apply forgiveness, you'll be able to document how the expenditures were made. Fact is, it's still a loan and it's going through a lender, and they're going to look for additional verification of the strength of your business, just as they would with any loan. And so they are going to look for all of these additional things in the process. So independent and self-employed, and I'm going to go back, that does not include, because of the way the legislation for Paycheck Protection was written, that did not include sole proprietors. They are actually included as small businesses. But there are similar things there, even if you're only one person as a sole proprietor yourself, in gathering up the information and basically what you show on your taxes as payment to that sole proprietor that comes from the business, that's income. So for the independent workers and self-employed, again, you can start this Friday. Independent contractors, you're looking for your 1099s. You need to collect all of those. Those who are self-employed, including those in the gig economy, where you're taking jobs from other companies and they're withholding payroll taxes and you're still getting a pay, you need to be able to track that. So basically, you're looking for your schedules from your 2019 return, if you filed it already or to be filed. That a lot of that comes under Schedule C, and Andrew Jordan, our CPA expert on the line, can talk more about that. Again, you need your 1099 forms that you've collected as an independent contractor, payroll tax filings reported to the IRS for the self-employed. And you can also include your home office. If you work from home a lot, then your home office costs, which are typically a percentage of that part of your house compared to your total house, can be counted in on that along with utility expenses. Here are a few other points of things that have come up as we've planned for this. If, as a lot of small business people do, they may have multiple businesses. They may be sole proprietorships, maybe a sole proprietorship that also has another operating entity that has its own employer identification number. The basic guidelines say there is only one loan per entity. So that does open the opportunity for people who may have an independent business under their social security number, and then they have another business with employees or without as a sole proprietor under an EIN to apply for 2 loans. If you have a sole proprietorship with a spouse, there essentially is only one application if it's the 2 of you drawing pay from that sole proprietorship business. The economic injury disaster loan does allow for you to come back and ask for increased funds, essentially an increase in the loan within 6 months. And that is, again, is directly to the SBA. And the Paycheck Protection Program and economic injury disaster loan can both be used together, but you have to be very specific on defining the use of funds. That's per the SBA guidelines. So again, if you have an economic injury loan, you can't, and you probably don't want to use that, frankly, for any of your payroll expenses. Focus the PPP on that because that's the forgivability. The other thing to think about in that is that because the economic injury has a longer window to apply until the end of this year, you can apply for the Paycheck Protection Loan now. And then after that closes, come back and ask for economic injury loan for other needs, depending on how the economy continues to shape up here as we go along. We're lagging again a little bit here. So basically, we have these very specific things within the program. The main thing to remember is to make sure that you get all of your paperwork together. You need to define and think about your short-term needs against your long-term goals. You need to review those then against the programs that are available, including the enhanced unemployment that's out there that David Gaines will be touching on, and whether that really is more beneficial to your business and to your employees, even more so than the Paycheck Protection Loan. And always seek professional guidance on that from your CPA, your accountant, your lender, and also the small business development centers in Missouri. There are 13 of them around the state, and there is one close to you. Please feel free to reach out to me directly, as you see here on the screen. If you, when we get done, if you have any follow-up questions or for a copy of the SBA program releases and guidance on these 2 programs, and we'll do the best we can to answer your questions on those. At this point, it's my pleasure to turn this over now to Rob Harrington and David Gaines to talk about the valued employees and the unemployment compensation that's beginning in Missouri now. David.
Well, good. Thank you, Rob. Good afternoon, everyone. Welcome for those of you who have joined us again for the second time. Thanks for coming back. Those of you who are with us the first time, welcome. Certainly appreciate you making time in this afternoon. As we had said a little earlier, sometimes the technology is not smooth and as snifty as we had hoped it would be. So please forgive us if it seems a little bit jerky. I hope it's a beautiful day where you are sitting out here in our office. We can see the white fluffy clouds here in central Missouri. So If Matt, you could back that up at the beginning, that would be great. Well, as we wait for him to do that for me, because I don't seem to have control of the program here. Wanted to let you know what we're going to talk about is two pieces of information, and for those of you who are on the call, two separate segments of folks that we're going to want to talk to. First, for those employers, we'll be talking about a program that Missouri developed a few years back that maybe you're not familiar with, and if you are, maybe this might be a good refresher. So we're going to touch on the highlights of that. And for those of you who are individuals employed by someone else's company, and you have some uncertainty in your employment stability, if you will, we'll be talking about the new federal pandemic unemployment program. So the first one for the state of Missouri is the Shared Work Program. It is administered by the Missouri Department of Labor and Industrial Relations. And I'm sorry, Matt, I'm not getting any slide control here.
Sorry to interrupt. It says you need to take control from my end.
All righty. If y'all hold on, I will send that request.
How about I cancel the request and we'll resend?
Yeah, that'll work. Again, folks, as Dr. Amy had said earlier in the program, that Zoom has changed some of the settings because we've had folks or reports of folks jumping in and taking over meetings, being a bunch of knuckleheads. We're trying to work through some of that new technology change today. So forgive us for the technical difficulties. We joked in our team meeting on Monday that we should put up the technical difficulty music and let it play for you while we're working through this. But for those of you who I don't know and I have not yet had the opportunity to meet, again, my name's David Gaines. I'm the managing director of Goldstone Consulting Group. We're a site selection and economic development firm based here in mid-Missouri, doing business nationally and internationally, of course, in the area of economic development, consulting, and site selection, business development, that kind of thing. And so getting back to the program, the Shared Work Program is administered by the Missouri Department of Labor and Industrial Relations. And this program was designed to give you as an employer an additional option to keep you from having to go through layoffs in your company. You guys have invested in those employees. You've got good talent that have the skills to perform the functions on a daily basis. And so as you go through either this economic cycle or maybe another one in the future that's related to your specific company, and your workloads start to decrease, and thereby needing a little bit less employees, maybe you can share this work across all of the employees as opposed to having to lay them off and basically reduce hours to them. So it's a dividing of that work across your current workforce. And again, Matt, I'm not getting screen control.
Okay, let me resend it.
So maybe it times out or something of that nature. So folks, forgive us again for that little bit of technical difficulty. But in this program, you can share the work across your employees, and so we'll just jump in here, and if you can see that, we'll just go with it in this format. But as an employer, you must submit an application for the program, and that application needs to be approved. So as you're thinking about what you're going to need to do with your workforce over the coming weeks or months, you want to plan ahead. And I think you'll hear this from all of our speakers today. You want to plan ahead and make sure that you're working in advance of any potential workforce issues or any financial issues that your company might see during this pandemic situation, or in the event of some other economic scenario for your company. In this shared work program, the employees receive a portion of unemployment benefits. They're going to work for you a little part-time, if you will, and receive part-time unemployment benefits from the state, and thereby making it a little bit more of a financially beneficial for them to continue to work with you in that. From an employer standpoint, there's three qualifications, or excuse me, there's several qualifications that you need to well, there we go. Several things that you need to look at from a qualification standpoint. Number one, a potential layoff needs to affect 3 or more employees for you to be able to participate in this program. And that 3 or more needs to be at least 10% or more of your current workforce. Those are some key boxes you need to check to make sure that you're going to be eligible for the program. Those workers that you would keep would basically be looking at least a 20% reduction in their wages, but no more than 40%. So for example, if you're having hourly employees and you're working them 5 days a week, 40 hours a week, and you cut them back Friday, you're back to 4 8-hour days. That would be your 20% reduction in their wages. And then the shared work program would be able to step in and make up some of that lost days worth of wages. If you're offering employee benefits, you need to continue to offer those employee benefits to those affected employees as if they're still full-time employees. So if you're offering some version of paid time off, whether that's paid vacation or sick leave or some other form of family leave, you need to keep that in place. If you're offering health insurance, dental insurance, those kinds of things, you need to keep all of your current benefits for those employees in place as if they were regularly working for you a couple of weeks ago. And of course, you have to certify that participating in the program will replace a layoff from your company of those affected employees. Rob mentioned it earlier. Rob O'Brien mentioned it earlier. I think you're going to hear it from the rest of the speakers this afternoon. The paperwork, the documentation has to be in order. So your quarterly wage reports that you are sending in on a quarterly basis, those have to be up to date. If there is remittance due, your employer's share of those payroll taxes are due, they need to be paid. So that's why we want to stress again the need to think about in advance of when you would have a potential change in your workforce, so that you have time to make sure that all of these requirements are up to date for your company. From an employee standpoint, they must be able to work. They must be available to work on any time that you're calling, and they need to be able to, or they need to accept whatever work you offer. So if you have a different, if they're working in the manufacturing side, but you need them to work over in the receiving, shipping and receiving, and you're going to offer less hours, they need to accept that for them to be able to continue. Those employees also need to be eligible for Missouri's regular unemployment benefits. So the number of quarters that they've worked for, that kind of thing. So if they're regularly eligible for unemployment benefits, then those are the employees that can participate in this program. On the employee side, now that's the review of the program, the shared work program for the employer. And we're going to give you a number here at the end of this presentation that you can call the Department of Labor and Industrial Relations and be more specific about your particular scenario. But part of that series of pieces of legislation that have been coming down from Washington that the president signed over the last several weeks is something that I think a lot of people have heard about and have focused on, and that's the federal pandemic unemployment compensation. And we know that as the program that from the federal government is going to offer an additional $600 per cycle over and above what the state unemployment benefit would be. And that's a federal program. Those are federal dollars coming down to the state to hand out. The individual, you as the employee, if you're facing a layoff or if you've already been laid off from your employment opportunity, you must be able to qualify currently for unemployment benefits. So if earlier in the year you were unemployed and you ran through all of that benefit period and you're still not employed, then this program is not, you're not going to be able to take part in this particular program. The benefits will be available sometime next week. That's what the schedule is. And they're retroactive back to the end of the month. It's a short-term program, so it ends the July 25th. That's kind of when the projections are that the pandemic from a public health point of view might come to an end. So we don't know whether this would be extended if the economic scenario continues to be not so good, or if it will end. These things are changing almost on a daily basis. There was some additional guidance that was coming down from the federal government to the states 2 days ago. So if at the end, when I give you this phone number, if you call, be patient. The folks in Jeff City have literally been overwhelmed with not only companies looking for assistance, but individuals. Yesterday in a conference call with the governor that I was privy to, he stated the fact that last week over 100,000 Missourians have applied for unemployment benefits. So the system is going to be busy. There's a lot of folks in there, so be patient. Make sure you have your documentation together. And for you employers that are on the call that are in that hiring position where you're actually looking to add quality talent and staff to your team, this is a great time to be out there looking for employees. As 6 weeks ago, the labor market was awfully tight. You couldn't find folks with the talent. Today, that's different. So there are folks out there, if you're in need of talent and you're hiring, to look at that. And if you're that company that's looking at that potential layoff, that shared work program might help you retain some of those quality folks so that you're not in a competitive, hopefully not in a competitive situation. The waiting period under the Pandemic Unemployment Compensation Act, the waiting period is waived for layoffs due to the COVID-19, the coronavirus scenario. You'll have to, again, document that that's the reason why the layoff has occurred. If there's a closure of a company, it may allow the employees to access benefits if that closure was related to the pandemic from the public health side. If you as an employee are receiving any form of paid leave, sick pay, vacation, family leave pay, any of those things where the employer is still paying you, but you have you're basically not at work, you're not gonna qualify. Okay. However, if you're at home due to a quarantine, and again, you're probably going to have some documentation from either your physician or from your local county health department, public health officials saying you need to be quarantined because you have had or believe you have had an exposure to coronavirus. You may qualify for unemployment benefits in this program at the federal level if you're not able to continue to work. The bad news is if you're having to stay home because your child's school or your child's daycare is closed because of the closure, the stay-at-home orders, both on the local and on the statewide basis, you're most likely not going to qualify for the federal program under this scenario. And again, if you've already exhausted all of your employment benefits for 2020 as an employee, your unemployment and benefits, then you're also not going to qualify. So for those of you who are on the call and can't see the screen, the Department of Labor and Industrial Relations in Jeff City, the phone number for them is 573-751-WORK, or that breaks out to 9675. So again, that phone number is 573-751-9675. 573-751-9675. That's the number to get into the Department of Labor. And whether you're the employer looking for shared work information, or whether you're the employee looking for unemployment benefit information, that number will take you, and then of course they'll direct you to the direction that you need to go. So thank you again for taking time to be a part of this call with us. The series will continue over the coming weeks with other great topics to help you understand what the workforce challenges and benefits are in the state of Missouri. I would encourage you, if you're a local company and you're needing some assistance, to reach out to your local economic development organization in your community. They are everywhere. If your county doesn't have one, reach out to the University of Missouri Extension Office. I can tell you for sure they have folks in 114 counties in Missouri, so there's somebody there that can direct you in the right direction, or reach out to any one of us that are on the call today, and we'll help guide you through. So again, thanks for your time. And next up is my buddy from Southern Missouri, Rob Harrington, with some agricultural information.
Well, Dave, thank you. Can you all hear me?
Yep, I can hear you well.
Okay, I'm trying to get my video back here. And I lost the screen. I lost the...
Okay, I will get it back up.
Sorry. Well, first of all, I want to say thank you for inviting me to speak today. It's a pleasure to be here. If you have questions, just remind you, if you have questions for any of us, please place them in the chat. And then when we're finished today, Amy or someone will go back through those and answer those questions, and we will answer those questions to the best of our ability. As my colleague David Gaines said, my name is Rob Harrington. I'm the Economic Development Director for the City of Houston. My topic, I might have drew, my topic is going to be agriculture and EIDL and PPP. We had several last week talk about what can these programs do for small agricultural businesses, which is a great topic to have in Missouri, specifically because of a large part of our economy is agriculture. And so I wanted to dive into that a little bit today with you, and just let you know, don't shoot the messenger if you hear something you don't like. But there are some things in here that I think will interest you. So let's see here. And I don't have control of the.
Bob, are you seeing your presentation on the screen?
I do see the presentation. I just can't move it.
Okay. Can you request control again?
I just did. I also want to point out, this is my, I don't know how many webinar today, and this is happening to all of them that is using Zoom. So we do apologize again for the technical difficulties. So. All right. Okay. First of all, payroll protection plan. So is eligibility for small farms? Do small farms, are they eligible? Yes. Just as Mr. O'Brien talked about earlier, there, as long as your organization has less than 500 employees, including sole proprietorships, independent contractors, self-employed persons, not-for-profit organizations, in the veterans organizations, you are eligible for the PPP. However, one thing I want to point out is that the payroll protection plan, most SBA programs, to be honest with you, have a revenue cap on them. And just like all the rest, the PPP does have a revenue cap for businesses. And those specific businesses, there is a website that I'll provide later on that you can go to that'll give you those caps specifically for agriculture. But for farmers, for small farm businesses, the cap is $1 million. And that is revenue, that is not profit. So please remember that, that $1 million revenue for a small row crop farm, beef production farmer, swine or poultry farmer, that is the cap. That is your cap. So also, I want to touch base a little bit with the Paycheck Protection Program. SBA is requiring that farms and agricultural businesses first explore Farm Services Agency loan programs. The link for those are below. You can either get it from the sustainableagriculture.net link that's there, or by going to fsa.usda.gov. Those two links will take you there. The reason why is SBA wants you to go to your FSA first is because of the relationship that you may have with your current FSA loan department. And then what can it be used for, and what are the stipulations? It's the same as what Mr. O'Brien talked about, you know, payroll costs, salaries, benefits, the payroll taxes, and what to consider. I would, in my opinion, farmers will want to evaluate all options available to them to see if PPP loans make the most sense for their operations. For example, small farms who have very few employees and associated payroll may not receive significant benefits from the PPP loans. Although if you do decide that the program is perfect for your farm company, contact your local SBA approved lenders. That's who PPP approved, your local lenders and banks, and see if that would work. So let's see if we can move on.
Rob, could you actually repeat just that last bit? There was quite a bit of feedback while you were talking.
Sure, Alexis, that's fine. So what to consider? So what the last bullet, what to consider, or you want me to go back talking about the stipulations and stuff?
I think it was just probably what to consider.
So my opinion, or what my recommendation would be, is to kind of look at PPP and see if it works for you. One caveat also, and this was in Rob O'Brien's piece as well, is foreign workers or independent contractors do not count or cannot receive, you cannot receive PPP benefits for those workers. So I know there are several companies throughout Missouri that do beef, swine, turkey, chicken farms, and vegetable farms that use foreign employees during this time. You would not be able to use PPP for those specific employees. Also, some hospitality businesses. such as in Branson. I know they bring a lot of people in from the Dominican Republic and areas to work at the shows and the hotels over the summertime. Those employees as well would not be eligible for these PPP benefits. So with that being said, look at who your employees are, look at all your circumstances, and see if PPP would work for you. And at the very last bit, worst case scenario, reach out to your local lenders. Here in Houston, where I work, there's 2 banks I know of that have had a ton of calls and have been working with several small businesses in the area on PPP, Payroll Protection Plan. And so reach out to them, and they should be up to date on all the changes as they come daily, and would be able to help you specifically on the agricultural side. Let's get to where we can. And then again, the payroll protection plan continued here. This is the link that I spoke about earlier. Go to this. It will tell you exactly what your cap can be as an agricultural farmer. I know, for instance, one that's on the top of my head, egg laying producer. So if you're specifically an egg, you're an egg producer, your cap's actually $16.5 million in revenue, which is significantly higher than row crop beef or swine. Don't know why that is, but that is just one of the examples. You can click on this link. It will take you to that page. It is a PDF. It's about 3 or 4 pages long, and you can find your specific agricultural business in that list. So as we move on to the EIDL, again, we're going to cover a little bit of what my colleague Rob O'Brien said, but $10 billion to expand the SBA's EIDL program. Part of this expansion added to the emergency grant, added an emergency grant, which is the $10,000. That's what, just to touch base, I'm telling all my local small businesses to go after first. And this is just my opinion. Some of these businesses are saying that they don't need a large grant or large loan to get by. And so the $10,000 is what I'm really pushing them to. So if you need anywhere up to $10,000, the EIDL would be good for you. However, with that being said, there is some argument in DC whether agricultural businesses can receive benefits from the EIDL. Congress has said that their intentions were to include agricultural small businesses when they pass this. However, SBA and then their disaster loan side of things does not allow agricultural businesses to apply for SBA disaster loans. So as of right now, agricultural enterprises, including those small businesses that do food production, fiber ranching, raising livestock, and aquaculture, they are unable to apply for this EIDL or Economic Injury Disaster Loan. We're looking and seeing that there is some conversations at Congress about a third stimulus or an update or correction on what the CARES Act that just passed to fix this. But nothing has been agreed on yet. But I would say if you, as always, if you're concerned about this or have any questions, contact your local lender, or reach out to SBA and talk to them. And again, as always, reach out to your local congressman or congresswoman and talk to them about getting this changed. Agriculture is a very important part of our economy in Missouri, and having the programs such as Economic Injury Disaster Loan to help them at this time is important. And so we need to continue to work on this, and your local Farm Bureau and their contacts in DC, as well as your other ag programs, are working hard to make sure this gets changed for you. There is a little lag, I apologize. And so now to kind of come back to what I talked about last week, programs outside the CARES Act. Again, you have your United States Department of Ag. This is mainly more for businesses, or excuse me, for communities, but I know there's some individuals from communities here. The business and community grants and loans. This is a great program. Towns, communities, state agencies, not-for-profit corporation, institutions of higher education, they're all eligible for this rural business development grant money. Your community has to be a population of 50,000 or less. I believe most of these are that are on this call. There is no maximum grant. However, smaller requests are given higher priority. So if you're in a community, those smaller grants, you can ask for as much money as you want. However, they do give out the smaller amounts first and then out to the bigger ones. There's no cost sharing requirement with these. Opportunity grants are limited up to 10% of the total rural business development grant annual funding. And there are two different funds, enterprise and opportunity funds, that organizations requesting funds can look to use. However, each fund has specific qualifications on what it can cover. Some examples: an enterprise grant must be used on projects that benefit small and emerging businesses in rural areas, as specified in the grant application. You can also use it for capitalization of revolving loan funds, including funds that will make loans for startups and working capital and rural business incubators. Opportunity grants, which is the other side of that, very similar in some of the cases in the programs, but some of the ones that stand out to me: long-term business strategic planning. And you can use this for some of the planning, as my colleagues David and Rob said, when it comes to disaster, planning for the next disaster. Hopefully that doesn't come anytime soon. Feasibility study, business plan. So if you really need to get in and get some business plan for your business, for your businesses in your community, this would be a great opportunity. And then just leadership and entrepreneur training. So those are some USDA Department of Ag grants and loans. I want to say too, today, added this morning, the USDA announced that current loans that you may have through local lenders, so some of your USDA small business loans, are going to be allowed to be deferred up to 6 months by the actual lender without the permission of USDA. This is something they added on to mirror what SBA is kind of doing. Your lender will just need to contact the local USDA about this deferment. After the 6-month deferment, though, you will need to begin paying again unless you apply for a continued deferment to the USDA. Not sure if the interest is going to accrue on these loans or not, and it should be a question that your local lender could answer for you. So that's good news from the USDA, that anybody that has current loans through the USDA, you can defer those payments for the next 6 months. We mentioned farm services earlier, the farm service program. Just to name a few, they do not have any specific programs for COVID-19, but they do have disaster relief programs. So just so for some of those agriculture companies on here that may not know this information, you know, Farm Service, there's a livestock forage program, which is compensation for eligible livestock producers that suffered like grazing losses due to drought or fire on land, or improved pasture land with permanent vegetation cover, or that is planted specifically for grazing. So there's that. Emergency assistance for livestock, honeybees, and farm-raised fish. Again, losses due to disease, but animal diseases, not COVID-19. We're talking about like cattle tick fever and things of that nature. Adverse weather or other conditions such as blizzards and wildfires. The Tree Assistant Program, otherwise known as TAP, to replant and rehabilitate eligible trees, bushes, and vines damaged by natural disasters. These are just a few of the things that FSA can provide to local farmers, agricultural businesses. Finally, community development block grants. Some of these grants that they're able to provide, again, we're going back to the community side of things. Disaster recovery. These grants assist local communities and other entities with long-term recovery, restoration, infrastructure, and economic revitalization related to specific presidentially declared disasters. Now, I'm not sure, and I have not been told that since the COVID-19 pandemic was declared, if there are specific funds from CDBG that are going towards COVID-19 purposes. However, there is talk about some funds through the, I want to say, community facilities piece of CDBG that could be used for telehealth, which is already a program that they provide. I think there's some more funds have been put towards that because of COVID-19. But again, I'm not for sure on that. Again, the other one would be long-term recovery other than community facilities, and that's just for local communities addressing emergency housing, public facilities, infrastructure, and business assistance needs that occur as a result of a natural or man-made disaster. So real quick, there is a lot of information in there that I went through as fast as I possibly could because I know there's a lot of people that need to get off for their next webinar. But if you have any questions, please reach out to me. My email was provided earlier today in chat, and if you want, you can please chat me after I'm finished, and I will give you that contact information. Again, thank you very much for attending. We appreciate it. We know your time is valuable, and we hope this information was beneficial to you. So with that, I think we're going to turn it over to Andrew, and he's going to give you some scenarios of specific companies and what programs they should possibly use from the CARES Act. So Andrew.
Perfect. Thank you, Rob. Can everyone hear me okay? Hopefully so. Let me know if you can't. But my name is Andrew Jordan. I am a CPA. The specialty of my firm is advising businesses. And so what I'm going to do today is walk through, as Rob said, some real world scenarios. These are both case studies based on actual clients of ours. We obviously changed the number a little bit to make them easier, and we cleaned up the name, some of those kind of details, but these are very much real world scenarios. So hopefully in doing these, and then we'll talk at the end, kind of how you can extrapolate from this a little bit further and get some generalities of when one program might be better than the other one. I will echo what's been said before. These programs are very complicated, and the way they interact together gets really even more complicated. So do make sure each individual situation, you are working with someone who knows the details and can walk through that. So this is a lot of dollars at stake. It's not the time you want to read a couple articles online or even attend a couple webinars and try and decide from there. I just want to recap because it has been a minute since the first Rob gave this overview, because we will be using some of these acronyms. The Payroll Protection Program, that's the PPP loans. These are the potentially forgivable loans. You start them with the SBA, but through your local bank. The Employee Retention Tax Credits, ERTCs, and these are something that have been, I think, kind of overlooked by the media in general, and for the right business, you'll see in an example of ours, very, very powerful. There's also the Economic Impact Disaster Loans, what's being pronounced EIDL loans. These are long-term loans, and about the $10,000 advance has been touched on a couple times. SBA is giving some guidance that for very small businesses that, well, actually for any business, they're going to probably use $1,000 per employee. That's the latest thing that they've been saying. So if you are a sole proprietorship, you might not get a $10,000 grant. It might only be a $1,000 grant. That is very frustrating for us, since as late as last week, we had a lot of people like me, a lot of CPAs. I myself was doing this, telling small businesses, hey, go get an EIDL loan. You can repay it whenever you want to, but you get a $10,000 grant. That was pretty meaningful. You get a $1,000 grant, that's not doing very much for very many people. So be aware of that. And as the guy said earlier, this thing is still changing, and we expect it to continue to do so. So who knows how that might exactly end up. CARES Act payroll tax deferral, I do want to touch on this a second. And on this is a program meant to help people. I will say, based on my experience as a CPA who, again, works mainly with businesses, I really don't like this program. I wish they wouldn't have done it as part of the CARES Act. For us, and I'm part of a bunch of networks with CPAs, so I'm with other CPAs, and we're comparing notes on this and kind of the consensus is this program really scares us. You can defer paying payroll taxes for 2020, and then you have to pay them back in 2 lumps, one at the end of 2021, one at the end of 2022. So on the surface, yeah, it's great. It's a interest-free loan, so to speak, from the government. But the fact that you have to pay it back in those lumps makes us really worried. So if you're a healthy business that has really great cash flow, maybe you're willing to do that, but I'm afraid this is a thing that could put businesses under if they don't know what they're doing and they're not accounting for it, and then you owe this big lump and they can't pay it, and that could be a death nail. So be careful of the payroll tax deferral. I'm not going to say it's not good for anyone. I am going to say just be careful with it. The last thing, and they talked about it too, but it needs to be part of a plan, part of the consideration for many businesses right now is furloughing employees, including partially furloughing employees in some cases. So these are kind of the tools in the toolbox that we go to businesses and we say, okay, what plan do we come up with? And now let's kind of peel back the curtain and let's look at 2 scenarios. So scenario 1, Andrew's Italian Restaurant. I am Andrew, I love Italian food, so that's why that's our example. I will say too, with some of these, with all the stress and things going on, if we can keep some levity, I think that's a good thing as much as we can. Monthly revenue, $150,000. So this is our example scenario. It's a restaurant, pretty good sized restaurant, but it's not unrealistically big based on what we have seen with our clients. Restaurants, 30 employees, let's say they make about $2,000 a month. That's about minimum wage, maybe slightly over. That gives us $60,000 average monthly payroll, right? 30 employees, $2,000 a month. Rent plus utilities for these guys, let's say it's $20,000 a month. And in this scenario, this restaurant is completely shut down for March, April, and May, and they reopen in the month of June. Let's say June 1st kind of thing they reopen. So right now they have furloughed everyone. And to give you kind of to help you extrapolate other businesses that would be in the same scenario, we're seeing gyms, theaters, bars, hotels, retail stores, etc. Especially if you have a larger number, relatively large, relatively large here, number of employees who are kind of on the lower end of the pay scale, and you're closed now and expect kind of a slower recovery, that's who's going to be kind of this model, right? This Andrew's Italian Restaurant. You'll be in the same boat if you're in one of these scenarios. Okay, based on this set of facts, here's what we see. A paycheck protection program, which is the forgivable loan. This is the one that people are worried is going to run out of money, and the government's talking about adding more money to the pot, another $250 billion. This has gotten so much media attention that what we're seeing is a lot of businesses are just saying, hey, I need a PPP, right? Like I need this loan. This is the one that I've heard about. It's the free money loan. Like obviously that's the better one. I don't want the one where I have to repay it. So let's walk through the scenario though. To qualify for the PPP loan, it's based on your payroll. And again, let's say that for the last little bit more than a year, $60,000 is the average monthly payroll for this business. So they can borrow $150,000, which is really a pretty good amount. They're approved for the loan on April 1st, let's say, but remember they're furloughed, right? Their restaurants literally shut down. Now some restaurants are able to keep operating a little bit, but again, we're simplifying a little bit here. No employees on payroll for the next 8 weeks because they're closed for April, they're closed for May, they reopen June 1. So how much of that $150,000 is going to be forgiven? Well, it depends on how much payroll you pay for the next 8 weeks after you get approval. 0, unfortunately, for these guys. You get to count your rent and utilities, but they can only be 25% of the total forgivable amount. And since the total forgivable amount is 0, you can't use any of your rent or utilities either. This was a wrinkle that was added last week by the SBA, by the way, and it really flipped for a number of people. They were planning on getting this just so they could get at least their rent and utilities forgiven. But when the requirement was added that only 25% of the amount forgiven could be rent and utilities, that changed it for some people. And that'd make a difference here. Nothing gets forgiven. So what's the end result? This business, this restaurant, now has a $150,000 loan that they have to repay over the next 2 years. Now it's a 1% interest, which is great. That's a really great interest rate. But because it's over 2 years, their monthly payments are going to be $6,300. Now they do get a deferral for making payments, as Rob talked about. But as soon as that deferral period is over, having to make an extra $6,300 a month payment for the next year and a half kind of thing, I think at that point, that's going to be devastating to this business, in my opinion, because they're going to get the money now, they're going to spend the money now, and then that repayment schedule is so small, it's going to be really, really tough for this business. So in this case, obviously the Italian restaurant case, this is not the good option for them. So let's look what the good option is. See if, there we go. All right, so the economic injury disaster loan. Now, we don't know how much they can qualify for. There's no formula that has really been officially shared. Some people have said it's going to be 4 times all of your expenses. Some have said it's going to be 12 months of your operating expenses. Again, it's a little unclear how some of these terms are going to work out. But let's say these guys can borrow a $500,000. And for businesses size, it doesn't seem like an unreasonable amount. That doesn't seem like that much. Okay, so, and I think there's a clarification down below, so thank you for that. But if they can borrow a $500,000 loan, because it's such a long loan term, even though that's a big amount, they're only gonna have to pay $2,300 a month. So even just looking at it from the perspective of PPP, where again, in this scenario, they're gonna get nothing, essentially. A short-term loan that's not gonna help them very much, but no free money. And this economic injury disaster loan, man, with $500,000 and only have to paying back $2,300 a month, that can be a tremendously helpful for a lot of businesses. So even that by itself, to me, I'd be leaning toward recommending the EIDL for this client. But it gets a lot better because there's the employee retention tax credit. This is the thing that I think the media has not talked about as much as maybe they should have. It only applies, it only is really helpful in certain circumstances. This happens to be one of them. You cannot use this tax credit with the PPP program, but you can use it with the EIDL program. So in this example, the businesses qualifies because they're completely shut down for some part, completely or partially shut down by the government for some part of Q2. So they qualify for Q2 for this program. And how this would work is the business would then pay their employees, let's say their normal pay. Again, that was $2,000 a month times 30 employees for the month of June. In our scenario, they're reopening in the month of June. June's the last month of Q2. Well, once they do that, because they qualify for second quarter, they get $1,000 per employee tax credit, which comes out of the payroll system. So you don't have to wait till next year to get the money back in your pocket. Next time you're doing your payroll taxes, you kind of settle up then and get that back. They just got $30,000 free and clear for the company, which is really better than the zero from the PPP. That's a decent chunk, especially because you can combine it with the EIDL loan. Now, let's take this a step further. This is where we start getting onto shaky ground. This is where you really got to know your numbers for your business. You really got to look at it a case-by-case basis, because in my example, I'm going to say that Q3, which starts in the month of July, is going to be not a great quarter for this restaurant, right? Restaurants, let's say we think they're going to be down. This restaurant in particular, they're going to continue to qualify in Q3 for this program, even though for no part of Q3 were they fully or partially shut down by the government. They still had under 80% of 2019's Q3's total income. That's not net income, it's total income is what they're looking at. So they still qualify for this credit. So walking through the rest of the scenario, for third quarter, they're going to pay everyone $2,000 a month, 30 employees. You can see the math here. The company is going to get for Q3 $90,000 more in cash, which they don't have to pay back. Again, this is a tax credit. So under the employee retention tax credit, this company is going to get a total of $120,000 that they don't have to repay, that they're going to get in fairly short order, and they're going to have a nice $500,000 loan that they can repay early if they want to, but they can hold on to that cash, pay it back $2,300 a month. That is a great result for this client, and a PPP would have been a terrible result. So I know we have a variety of people on here. What I just really want to emphasize as a CPA is make sure the clients are really, your clients, whoever you are, if you're a small business yourself, if you're talking to small businesses, make sure that they do the math. because man, there's a lot of money at stake. And this isn't even like a giant business, right? This is a relatively small one. So this just compares, and I've already kind of went through this. One option is so much better than the other. Okay, scenario 2. This is what we call Emma's manufacturing, and Emma's my office manager, so she gets her own company here. Same about size as far as monthly revenue, but they only have 10 employees. And this is based on a client of ours that's actually a specialty manufacturer. So these employees make a little bit more on average. They make $3,000 a month, let's say. So $30,000 monthly average payroll. The rent plus utilities, because it's a random kind of small community, a random building in a very small community. So the real estate price is very small. $5,000 a month is what they pay, includes utilities. They're an essential service because they're manufacturing something that helps another essential service. So they actually never got shut down, and they're working at full capacity, and they have a backlog. So other businesses in this scenario includes any professional services you can think of: lawyers, CPAs, dentists, potentially, some of the other medical practitioners as well, potentially. Dentists, I know a lot of them are shut down right now, but specialty manufacturing as well. Any business that is not severely impacted by coronavirus. So actually, maybe I'll take out the dentist because I'm just thinking about this. My dentist actually is shut down right now. But if you're not severely impacted by the coronavirus, especially if you have an average employee pay that is relatively high, but it's below $100,000 each. In that scenario, you're going to maximize your PPP. So this is the Paycheck Protection Program scenario where this one works a lot better. These guys are going to qualify for a $75,000 loan. That's $30,000 monthly payroll times 2.5. Let's say they got approved for it, same as in the other scenario, on April 1st. And then in the 8-week period after their approval, they're going to get $60,000 of payrolls, what they're going to spend. And they're going to have $5,000 a month is what we said, rent and utilities, so 2 months of that. $60,000 in payroll, $10,000, which is under the 25% of rent and utilities. They're going to get $70,000 of that loan forgiven. And they're going to be left with basically a $70,000 check that's theirs free and clear, and a $5,000 loan that they need to repay over the next 2 years at 1% interest. But you can repay that if you want to right away, and there's no penalty for early payment. So if they want to, they could just do that and just keep the $70,000. Versus, and this is actually pretty easy math, economic injury disaster loan. Like again, we have no idea what they qualify for. Let's say they qualify for a $250,000 loan. We don't know how much they will, but in that case, it would be about an $1,100 payment for them. It's still not a bad option. And I got to say, like, this is why I say case by case basis, because in some cases, a business would say, look, $70,000 free and clear would be really nice, but that's not going to be enough cash for me. Like, I'm still going to be out of business 3 months from now. I need a lot more cash than that, or I'm going under. And I'm willing to take on a loan. Well, hey, in that case, Emma should consider this economic injury disaster loan instead of the quote unquote free money, the grant from the PPP. And in this case, part of what makes PPP so much more attractive is, hey, this business was never fully or partially shut down by government order, which is one of the ways you can qualify for the employee retention tax credit. And their income was never 50% or less compared to the same quarter in the prior year. So in order to qualify initially, that's 50% or less you have to be at. In order to continue qualifying, you have to be, for future quarters, 80% or less. And you can qualify all the way through the end of 2020. One other really important thing on this is that the amount of credit you can get through this is definitely limited. It's why it's better for lower, you're better off having a larger number of lower paid employees for this credit, because you can only get 50% of the wages you pay them up to $10,000 of wages, which gives you a $5,000 credit per person. So that's a really important thing to know. If you only have a handful of employees, the most you can get is $5,000 per employee from this employee retention tax credit. Okay, so again, comparing them, just recapping, $70,000 free and clear from the PPP, that's a really good option. But I will also say, even though they wouldn't qualify for the employee retention tax credit, even though it's free money, and I hear from a lot of people who say, well, I don't want to take on debt. I agree, I don't want you to take on debt either, but if 70,000 isn't going to be enough to get you through this, if you say I need at least 150,000, there's no point in getting the 70,000 if you're not going to have enough to make it through. So in some of these cases, people should still consider the economic injury disaster loan, in my opinion. All right, so I want to wrap up this with some other considerations. This is other just important thing about these programs. Some of the risk I see with these, the Paycheck Protection Program has a real risk if your payroll drops suddenly, right? You get this, everything is going well, and then all of a sudden in April, after you've already gotten it and you're in the 8-week period, your demand just drops off from your customer base for whatever reason. Maybe you are shut down, and that's not expected right now, but maybe there's more shutdowns that come that are stricter. Maybe your customers just stop buying your product for whatever reason, and it's hard for you to afford to keep paying payroll, and you love to be able to furlough your people, but if you do, then you lose the forgiveness, so you don't really get ahead anymore. That makes this program a whole lot less effective. So you got to think forward through that. One strategy that some people have recommended is you can wait to apply. The risk there is if the program runs out of money, or the SBA could make any number of other rules that could limit this. So the idea of, well, maybe I wait a month and kind of see, I'm not recommending that personally to any of my clients. I'll put it that way. Not to say it might not be the right call for someone, I just have not recommended that to anyone. The economic injury disaster loan, some of the risk I see with this is you might not qualify at all, or you might qualify for a lot smaller amount than you need, because we don't know how much people are going to qualify for on this. Also, this loan is taking weeks and weeks to get funding, and there is an online application that takes you maybe 15 or 20 minutes, but what we're hearing is that after that, it's expected you're going to have quite a lot of documentation. It's not going to be as bad as a traditional SBA loan, but it is going to be quite a lot of documentation still. So this one's more work for sure, and it's going to take a while. Even if you get a lot of cash, if you can't survive the month while you're waiting for the cash, this one doesn't necessarily help you. Now, there are some things called bridge loans that you might look at. And then actually, let me jump back here. The last thing to talk about is the employee retention tax credits. Not sure how to go back a slide, but I'd say, okay. The risk here is, what if you, thank you. Like in our example, right, it was kind of perfect scenario. You're reopened in June, so you have payroll in June that you get the credit on, and then you qualify in third quarter, and so you get the credit for all of third quarter. But what if you didn't reopen until July? Well, then you don't have any payroll in June, so there's no credit from June. So you reopen in July, but then third quarter, you're at 85% of last year's total income instead of being at 80%, which would qualify. So you don't qualify. So in that scenario, it's entirely possible that this restaurant, because they'd open a little bit later, and then because they would rebound a little bit faster, wouldn't qualify for anything instead of qualifying for $120,000. That would not be that hard of a thing to have happen. So with our clients who are doing this in my mind is kind of an advanced thing. You better have timely books. You better have very accurate books. You better know your numbers for last year as well. And you better be watching it really closely. It's just my only advice on this. So that is it. I do have a couple of resources here at the end. These are just kind of basic ones, links to, for each of those 3 programs I talked about, some more information about them if you're curious. And that is all of my kind of scenarios to walk through. So I think back over to Amy, perhaps. Oh, sorry, let me, we skipped a slide. We started doing this just because we wanted to help people and get the information out there. If you do have a business that this was helpful, but you still have some really different or specific scenarios you want to walk through, send me an email. I'll respond with a link. You can do a free 30-minute session with me, and we'll just walk through your specific scenario if that would be helpful. So, thank you, everyone.
Hey, thank you, Andrew. That was absolutely tremendous. I enjoyed everyone's presentations this week. And we have a lot of questions that have come in. If you don't mind to stick around and answer some of the questions. One of the first questions that we received was, does the 501c include 501c4? And that question came in when Rob O'Brien was talking.
So the 501c4s are really kind of classed around economic development organizations, somewhat like C6s, which are trade organizations. And those to date have been excluded in that. There has been dialogue going on at the with the U.S. Chamber, with IEDC, with a number of them, asking if those can be reclassified in there. So basically what is captured in that when they say 501c3 or what we would say are true not-for-profit organizations with a charitable intent.
Okay, we had another question, Rob O'Brien. It is in regard to the EIDL. And the question is that in regards to the EIDL, there was a request for two numbers, both gross and cost of goods sold. The presenter that was specifically talking about this said that the cost of goods sold box should have asked for all expenses, meaning the cost of goods sold and the operating expenses. The speaker recommended that a person files a new application to include all expenses, and that the first app could not be amended and be filed again. Do you have any feedback?
No, really, that is getting into that very much of the details on documentation that we've talked about throughout this, and I would throw that back to Andrew to talk through in some more detail.
Here's our understanding of this, and this has been a question that's come up a lot. What is the answer? Unfortunately, we don't have it, and this is the answer for a lot of these things. I'll tell you our best guess is, what I'm telling clients is cost of goods sold is cost of goods sold. It's not total expenses. It's a stupid application. It doesn't make any sense to me, and it's confusing to a lot of people. I agree. I would think they'd want to see total expenses, but it says cost of goods sold, and cost of goods sold is very different from total expenses. The advice that we have been giving people and that other CPAs I've checked with are saying as well is put in your income for income, put in your cost of goods sold for cost of goods sold. And I can't guarantee what the SBA will or will not do, but part of this program is a couple weeks later, you're going to get assigned an SBA caseworker who will contact you. And my thought is, like, you will be talking to an actual human being at some time. If it works out that if you put cost of goods sold instead of your total expenses, and therefore they exclude your total expenses, that would be really ridiculous in my mind. I don't foresee that happening.
I'm unsure who asked the question in the chat, but I assume that we're talking about the same speaker and presentation this morning, and that was directly from SBA, and Lisa Zimmerman was the speaker there. She's in the Kansas City district office, I believe. So
sounds good.
You might want to confirm that.
Take that under advisement, then consider putting it all in there. I do know some people have put it, there's a line for nonprofits that talks about like total expenses for nonprofits. It's down a couple below cost of goods sold. Some people have advised their clients to put it there. That seems needlessly confusing any way you deal with it. Again, my hope is that whichever way you do it, whether you put all expenses there or just cost of goods sold, you would not be penalized. But if we're thinking the SBA is saying you would be, then they know something I don't.
In Rob O'Brien's information, he provided the contact details for the Missouri SBDC. And if you call the Missouri SBDC, they will assign a business counselor to work with you that can help you fill out some of these applications, because I know that they are confusing, and then you can work with your own personal advocate. Another question that came through is, could you please address the pandemic and unemployment as it relates to small business owners? I have heard both that they are eligible and that they are not. I don't think it's unemployment, it says UI. If Jackie is still on and wants to clarify that question, we can address it. Alexis posted, it's her understanding that individuals caring for a child will qualify if there is inability to work is due to place of care or school closure. Can you please clarify this?
Yeah, I'll jump in and answer that question. And Alexa, I think I sent that to you in the chat. Based on the research that I did, and I went back to try to find that document in the letter from the U.S. Department of Labor regarding that. It did say that that was an ineligible, excuse me, an ineligible scenario. And I think that might be due to the fact that your inability to go to work was not because your job's not there, it's just because you don't have daycare. So I think that might be the quality, you know, the gray line there that separates that part. But again, I caution to say that you know, all of these rules and individual clarifications are still coming down the pike, and it will depend on the individual scenario. To answer the other question related to the individual small business owner independent contractor scenario, I think they're working on trying to clarify that as well too, as to which program they would be best suited for. So still a lot of figuring out and navigating to do, and hopefully those who need to do it can find their way fairly quickly for their own benefit.
Okay, is the 10,000 guaranteed, or is that a formula of the total loan?
The way that the SBA guidance speaks to that is that you make your economic injury loan application, the $10,000 advance, what they call advanced emergency loan, is part of that, which you receive even if you are not given the loan. If you're turned down from the loan, you can still receive the advanced emergency loan, which essentially is yours and no repayment required. So it does look like a grant at the end.
And I'll piggyback. Well, it was really clear in my mind from reading the law itself that that was what would happen. The SBA has written some guidance, some came out yesterday afternoon, that their intention is, at least as of yesterday afternoon, $1,000 per employee up to $10,000. And so I couldn't say for sure that that's really what they'll do, but that's what they're making noises of. So we're advising people I wouldn't count on getting $10,000, unfortunately. I think that was the original intent.
As we said early on, I think every speaker reiterated that they keep adding the guidance on here as they go through the process. Even, for example, on payroll protection, there was guidance that was going around prior to the April 3rd opening of that particular program, but the SBA actual guidelines did not come out until the Thursday afternoon prior to that Friday, and it changed some things. And so they're going to continue to do that. I think you may not count on it, but I wouldn't let that hold me back from applying if that is a scenario that works for your organization. Again, Andrew has given you some scenarios to think about in that, using the economic injury loan and the employment retention credit versus payroll protection loan. But you know, if the thought is you're just going to go and say, I just want to ask for $10,000 and then figure that's going to be a grant, I wouldn't approach it that way. Really think through the kind of financing you need and the ability to pay it back long term, and what that means for your employees. If you're an independent contractor or sole proprietor, you are the employee, and so you need to think through that process and how it impacts you.
Hey, thank you, Rob and Andrew. I received clarification on the unemployment question. Are small business owners eligible for the pandemic unemployment?
Sorry about that. Already working on a second regularly scheduled conference call. My understanding is no, but I would most likely want to refer that question over to Andrew Jordan, the CPA, to get his input on that.
Is the question, will a self-employed person qualify for unemployment?
I believe that was the way I understood that, yes.
Okay. Then I would say, yes, per the law, the CARES Act does expand unemployment to self-employed people. Now, we get some questions of people who are self-employed as like a side job. I talked to Missouri about that last week. They said, look, if your main job is still employing you, you might have lost significant revenue from like your side job going dead, but they're not going to give you unemployment for that. But if your sole source of income is self-employment, then that you do qualify. The caveat here is Missouri, like essentially every state, self-employed people have never qualified for unemployment until like a week ago. And so the states are scrambling. Their systems literally cannot handle it. And so they don't have the fields to ask the right questions. And so they're not processing the claims. They will process them. They will be retroactive. But what they told me was just keep checking back until they're ready to. But yes, if you're self-employed, CARES Act does say you will get unemployment benefits.
And see, that goes to what I was saying earlier about how this large $2 trillion piece of legislation and how fast it has come down still takes time for folks to understand the little nuances and regulations related to that. So thank you, Andrew. I would encourage folks to keep checking at that.
Next week on April 14th, we'll be speaking with the Missouri Job Center, and we're also inviting our Department of Higher Education, Department of Labor Workforce Development Specialists, and they'll be talking about unemployment benefits for small businesses, as well as some other workforce resources they have. We have one final question for the group. In regard to FSA, provide clarification to confirm if they do consider pandemic to be a natural disaster.
So looking and doing the research I did through FSA, the way I understand it is FSA has their programs that they offer, which I covered. None of those programs consider pandemic, such as COVID-19, a natural disaster for those specific programs. The type of diseases they do mention have to do with diseases for animals, such as I mentioned, like cattle tick fever, or other, I'm not a farmer, so I don't know a lot of those, but the animal specific diseases or diseases to your crops. So I would say no, they do not cover COVID-19 under FSA. And so you wouldn't be able to, that's why I said there's not a lot of help for agricultural business in specifically COVID-19, for COVID-19, other than PPP, which does allow agricultural businesses, as long as they're under the employee count and they're under the revenue amounts, to apply for. But the EIDL and the USDA, FSA, those programs do not have a COVID-19 program per se.
And I'm also seeing from the state level, because we asked about that, excuse me here, let me mute this other conference call. We also asked that question several weeks ago of the Department of Economic Development, if there would be some insistence and support coming from the Missouri Department of Agriculture for our small business. So many of our 114 counties, agriculture is the #1 employer. And by far, a lot of those small farmers are companies that employ 3, 4, and 5 employees. And due to huge swings in values of commodity in storage on the farm, some of these guys are really looking at a very difficult springtime planting season from a financial standpoint.
And Alexis, I know you were the one who asked that question, and when we end, if you want to stay on, we can dive into that a little bit more, as well as your other questions you had, because I know, if I understand correctly, I believe you work with a lot of small businesses yourself, so be interesting to see your take on some of this.
Absolutely. The group will stay on for a few minutes following the webinar. I do want to thank our experts today for their information. It is always changing and continuing to develop, and that's why they dug a little deeper and provided the excellent scenarios for us today. I'm going to go ahead and stop the recording, but you are welcome to stay on and join us for a further discussion. Thanks for attending today.